Welcome all to the session on corporate finance. Through this video, you will get exposure related to a concept called profit and wealth maximization. Let us start with something called as wealth maximization. So before moving on, you should understand that what they are planning to maximize, whether it is going to be a profit or whether it is going to be a wealth. Profit as a term is something so vague. So what they are going to do in profit, and also it is something a short term. But when it comes to wealth maximization, it is something for a long term of an organization. So that's the reason in the wealth maximization advantage, you can see that long term value mentioned as a first major advantage. So what is that long term value? Let us get back into an example that is related to Tata Motors. So Tata Motors had a very big acquisition in 2007. They acquired a company called as Jaguar Land Rover from Ford. You know that Ford is possibly considered as one of the biggest player in the car industry. So this Ford made a very wrong decision. They went on acquiring more companies that is available all over the globe, right, in search of making the company bigger. That decision actually went wrong for that company, and they modernized the plans, they went into several other strategies, but still they are not able to turn around. So it was one fine possible day or maybe things, right, when they had a discussion with Tata groups. So they asked Tata Motors, why can't they buy the company which is reeling under pressure like Jaguar Land Rover. So Tata had a very good deal actually in this. So the company was bought possibly at a very cheaper valuation. But most of the investors thought that a company which is not doing better like Jaguar and Land Rover, why Tata Motors has to purchase by the way of acquisition? Because Tata Motors was not a very big company, right, in the time of 2007. They were not having a very big models of car. They doesn't have a global presence. But this company took a very bold decision because the company had an expectation that they can do something best in the future. So after that company was acquired, so there were many strategic plans that went on, and possibly for nearly 6 to 7 years the company did not do much better. Everybody thought that Tata Motors made a very bad decision in that case, but it started its possible what you could say the turnaround, right, after the year of 2014 and 15. So they made the brand very big. So now if you see, the Tata Motors major revenue comes from the brand of Jaguar and Land Rover, and in turn Tata has also acquired the technology that is required to produce the cars in India by the acquisition of this Jaguar and Land Rover. So now you might have got an idea how this wealth maximization would have worked for this company called as Tata Motors. So just if we make a comparison between the balance sheet of 2007 and the current balance sheet, possibly it may be of several times the balance sheet size has increased. This is purely called as wealth maximization. So Tata Motors didn't think of what is going to happen to that company in 2008 or 2009. They had a very long-term vision in their mind. What is going to happen to the whole company as a Tata Motors after several years? So as of now, the shareholders of the company and also the company is reaping the benefits of acquiring a global brand like Jaguar Land Rover. So the wealth has increased for the Tata Motors because of that decision. The second point is the shareholders' thought has to be aligned with that manager's goals. A manager may be having something in their mind and the shareholder may be having something in their mind. A shareholder may be thinking that a company should grow exponentially, the share prices should grow exponentially, and the dividends should also be paid. So there should be a balance between both the things. The managers may be thinking that the company should go on acquiring. So for that acquisition, they will think that the money has to be kept inside that company as reserves and also as a retained earnings, so they can finance the projects that is going to come up in the future. So you can see there is possibly a conflict here. Shareholder thinks in one way and the manager thinks in one way, but there should be a balance between the things. So there should be an alignment between the shareholder and the manager's goal. Both the people should be in a situation like a win-win situation. So for this, the wealth maximization helps. The third thing is a clear framework for any kind of decision making. So we had an example that is related to Tata Motors. The company was very clear when they made the decision. So this is not for a shorter term. In 2007, they thought what is going to happen in 2020 or 25 for this company because of this acquisition. The same kind of decision they had made in different companies. So another example we had in one more video that is related to Tata Consumers. So what they are going to do in the future. So what they are actually doing now, it is going to make that company exponentially grow in future. That exponential growth is going to result in the wealth maximization of a company. Then wealth maximization is not with full of advantages. There is also disadvantages in wealth maximization. So the other business goals may suffer. What is the other business goals? Possibly in a very big conglomerate like Tata, or else a very big conglomerate like maybe like Mahindra, right? So a goal that has been taken to increase the wealth of one company, so possibly may have an impact in some of the group companies. For example, TCS is considered as one of the best company and considered as a cash cow in the Tata's table. It was considered once, but if now we go and check, right, the decision that has been taken by avoiding TCS, because TCS can grow organically on its own. So they started concentrating on the other companies like Tata Motors, maybe hotel chains of Tata, or maybe like Tata Global Beverages, right? So like that, the company went on expanding the other companies and those companies started growing. But just consider TCS. So now other Tata companies are now equal to the TCS when it comes to the possibly like wealth expansion that is being made. So then the wealth maximization may sometimes go against that public interest. So public means any kind of people who are involved and the stakeholders, right, can also be influenced or possibly impacted by the way of a company's urge of growing bigger and bigger. And possibly it can even have a conflict over the manager's goals. As already said, that manager's goal may be influencing the company in expanding by having the internal sources of money for which dividend may not be paid, but shareholders may be expecting dividends. So there is going to be a possible conflict also, right? When there is positive thing, there is also going to be something negative. So in this case, the manager's goals can also become positive, or it can also be a disadvantage when it comes to a wealth maximization. Sometimes there may be different projects that is available, but a manager may think that this specific project may do better when compared with the opportunity cost, right? When we just plan for the cost benefit or the opportunity cost related things, a manager may say that this is considered as a best project. So possibly a shareholder would say that no, this can be a best project. So some decision has to be made. So there is going to be a conflict when it comes to the manager's goal. Next, from the wealth maximization concepts, we are going to move into a concept called as profit maximization. So what is profit? That word itself is vague, and again it is not a physical activity, and it's also a function of both the revenue and cost, and it ignores the time value of money. So let us have a discussion related to this. Okay, what is profit? A company want to increase the profit. How they are going to increase the profit? Whether it is going to be gross profit, whether it is going to be net profit, whether it is going to be a net profit before depreciation and amortization or after depreciation and amortization, or whether it is going to be a earnings before interest and tax, or whether it is going to be a earnings after tax. What does that profit means? So that concept itself is something vague. Or are we talking about a comparison of a profit where 2 or 3 quarters which cannot be compared? So what are we going to do? So the profit as a term itself is something vague. And one more thing, so how you are going to increase the profit? Whether you are going to touch in the expenses related part, or whether you are going to make some changes in the revenue related concepts of the company. Either the company has to increase the revenue, or the company has to reduce the cost. A company, when they increases the revenue, there is some expenses that is always required. So how they can bring down the expenses of a company and still have a better revenue? So again, it will go contradictory. So again, so whether it is going to be a short-term increase in revenue or else they are going to have a projection for the future. In the example of the Tata Motors didn't think about continuously innovating the things into their local brands like India. They went for acquiring another company. They want to grow the revenue of the company in multiple ways. Okay, so a company has to think from that perspective. So when it comes to the cost related components, how a company is going to bring down the cost? By the way of bringing down the cost also, net profit of a company can increase, but how they are going to bring down the cost? Whether it is going to be with a compromise in quality, whether it is going to be by the way of reducing the employee cost. You see, for a company like TCS, a company majorly depends on the employees. It is the cognitive power of a person that is most important in a service kind of industry. So the employee cost there, if it has to be reduced, it is at the expenses of the company is making a biggest errors for the future. Because cognitive power is a power that is required for a company like which is involved in services. But when it comes to a manufacturing company, yes, the investment into other kind of assets is so important. Okay, now let us get back into the concept related to the cost. So how you are going to bring down the cost? So there should be multiple questions how you can bring down, whether you are going to target at the vendor end to bring down the cost through the way of contracts that is related to purchasing of the raw materials, or you are going to postpone the maintenance. If you postpone the maintenance, what will happen? One fine day, possibly your company's operations may come to standstill because of a major breakdown, right? Are you not going to pay interest properly? So you are under the lens of the government, so you cannot avoid that. So are you going to fire the people and work with the people who are available? So manpower is something that is so important for a company. Without a skilled manpower, you cannot operate. So what is that cost component you are going to reduce? Even if you are going to reduce that component, it is going to be for a very short term. And a company, when they go for a profit maximization, they skip the time value of money. So what is the time value of money? A 1 rupee that is available in your hand today will not have the same value tomorrow or maybe the next year. There is a concept we know called as inflation. So in India, it averages around 5, 5.5, 6. The government has to release a proper data. So it differs. Let us take 5%, which means every year the cost of living increases by 5%. So the money that we have in hand today, it is not going to be the same in future unless or until it is going to be invested. So here in this profit maximization, it doesn't consider the time value of money. It considers all the projects equal. Let's say a project is going to provide a 3 years of return. The project A is going to give 5 lakhs in the first year, 10 lakhs in the second year, and possibly a 12 lakhs in the third year. So 5, 10 and possibly 11 we can consider. Consider another project in which the company possibly start with 10 lakhs in the first year, maybe 6 or 7 lakhs in the second year, and maybe 7 or 8 lakhs in the third year. In this case, you can see that possibly if you just make a comparison and if both comes to 15 lakhs or something, we would say that both the projects are best. But when it comes to wealth maximization, you should think that the time value is so important. This profit maximization ignores the time value. A 10 lakh that a company can generate next year is something bigger than a company which generates the same 10 lakhs maybe in the third year or maybe in the fourth year, because the value of money differs each and every year. So this profit maximization ignores this time value of money. Then we can move on into a comparison that is related to wealth maximization and profit maximization. Through the 10 minutes or maybe the discussion that happened, you would have got an idea. Wealth maximization is always for the future of a company and it is for the long-term value. So we had the discussion that is related to Tata Motors. So how they had created wealth to Tata Motors by an acquisition related to Jaguar and Land Rover. So the same kind of thing is happening in many companies. So even Sun Pharmaceutical made such a bold decision. So they acquired a company called possibly Ranbaxy, and because of that they ran into certain trouble for the few years, but it has created more wealth for the shareholders now. So in this wealth maximization, a company constantly thinks about how the company is going to behave in the future. So how big the company is going to become, right? So it is related to the long-term value that can be created to the shareholders. But when it comes to the profit maximization, again we are just summing up. So it is for a short term. It may be applicable for a few months or it may be for a few years, but because of the decision that is taken here, the company may suffer. And there may be possibly employee issues and also the customer related issues which may crop up in the future because of this profit maximization. So you are going to bring down the employee cost, and because of that possibly you may not have a skilled people inside your company, and it may lead to possibly an employee related issue. And since you are not having the best people inside that company, you cannot serve the customer best, and obviously it may lead to even a customer dissatisfaction and it may lead to customer issues. So in this video we had a discussion that is related to wealth and profit maximization. Let us continue with stream of videos. Thank you.